All right, so the Federal Reserve is widely expected to raise interest rates for the very last time during their next meeting on the 3rd of May. They're expected to raise interest rates by another 25 basis points or 0.25% from the current level of 4.75% range to 5% range to 5% to 5.25% range, and they're going to announce a pause. So that means they're going to end their rate hike cycle in the next meeting. So you can see that from the 14th of June, which is the next meeting, there's a close to 70% probability that they are going to not hike anymore. They're going to pause, or they may even cut interest rates. Now, this is something that I widely agree with, that the Fed is coming to the end of their interest rate hike cycle. Now, there are many people out there who are now saying that the moment the Fed pauses or cuts interest rates, the stock market is going to crash. We're going to have a recession. Now, how true is this? Let's find out in this video. Now, first, let's take a look at the charts to decode the price action of the markets. So currently the markets remain on an uptrend. As you can see, the 20 exponential moving average, 20 EMA above the 40 EMA. So that tells us that the market's on a short-term uptrend. At the same time, the 50 moving average is above the 150 moving average. That tells us that the market's on a medium-term uptrend. And finally, the price is above the 200 moving average, and the 200 is sloping up. So all the price action tells us is that the market is still on its very, very strong uptrend. Now, since the low that was made in October of last year, currently the market has been up for 7 months. So I've said that my thesis is that we are in a bull market. So we are 7 months into a bull market. But of course, a lot of people don't believe that. Many people believe that, no, this is not a bull market. We are still in a bear market rally, which of course is possible. I'm not saying it's impossible, because officially the S&P is only in a bull market if it closes above 4,200 points. That's about 20% above the October low. So again, like I said, we are not officially in a bull market, but I think we're in a bull market. Now again, if this is not a bull market and it's a bear market rally, which is what most people think, then my God, it's the longest bear market rally in history, because never before has a bear market rally lasted for 7 months. So if it truly goes back down to make a new low, then I would say, wow, that's going to be pretty amazing. But I think very low likelihood of that happening. Now, having said that, remember that we are on an uptrend, but we are now approaching a pretty critical level in terms of technical levels. Why? Because, well, if you take a look at the charts, you can see that we are approaching a significant level of resistance. You can see that this was a previous level of support that became resistance, resistance over here. And again, we are approaching that level of resistance once again. So can we break that level of resistance? Well, time will tell. A lot depends on the earnings coming up. So we started earnings season a couple of weeks ago, but a lot of the major companies have not yet announced earnings. So if earnings turn out to be better than expected, which they have so far, then we could break this resistance level, close above 4,002 and confirm the bull market. But if earnings are weaker than expected, then don't be surprised that we do get a pullback even on an uptrend. So remember that on an uptrend, nothing goes up in a straight line. You don't get one straight line up. You will have a series of wave up and wave down patterns, right? So we've got this wave up here, wave down, wave up, wave down, wave up, and then again reaching that level of resistance. So again, if earnings disappoint, then we could, find that resistance and we could trade back down again, back to this level of support. That's definitely a possibility. So does that mean the bull market's dead? No. So whether it goes up right now or it pulls back first, I believe that eventually it will break that resistance and we will confirm the bull market. It's only a question of time. Now, personally, if you ask me, which one would I prefer? I would actually prefer the market to pull back first before eventually breaking out. And the reason is because so far I have not been hardly buying anything this year. Last year, I invested a lot into stocks, especially towards the last quarter of last year. And what happens is at the beginning of every year, I always set aside a certain amount of money to invest in the markets. This year, so far, whatever I've set aside, I've only invested 15% of my planned investments. And the reason is because many of the stocks that I love, they are not at my buy levels. As an investor, I only like to buy if, number one, the stock is undervalued enough, and number two, it has retraced to a support level. Now, the problem is the last few months, prices have not been coming down. They keep going up. Retracements have been very low. They're not very undervalued. So far this year, I've hardly bought anything, which I don't like. I like to buy every year to build my portfolio. So, one part of me hopes that we're going to at least come back down again so I can, again, accumulate more shares before going up. But again, who am I to tell the market what to do? The market does what it does, right? So the important thing I keep saying is that as an investor or trader, your decision to invest and trade is purely based on the fundamentals of the company, the price action, the valuation, and should never be based on our predictions of where the market will go in the short term, because it's impossible to predict where the market is going to go, right? Will it, break up right now? Will it pull back? No one knows, right? But again, if you hold great companies, they will always go up eventually, right? If not this year, then the next year or the year after that. So it pays to stay in the markets if you're holding great companies. Now, as you guys know, we just started earnings season a couple of weeks ago, and the banks were the first to announce their results, and they were way better than expected. In fact, a lot of people got fooled. People like Jamie Dimon, the CEO of JP Morgan, he was saying for the longest time that storm clouds are gathering, there's going to be a bad recession, we're all going to die. Right? No, he didn't say that, but I'm just exaggerating, right? And he said that the US banking turmoil is not over. I see long-term repercussions. And a lot of people, sold in panic. They sold their bank stocks, right? But what happened? Damn it, JP Morgan and Bank of America, they announced great earnings. JP Morgan's revenues hit a record high of $38.3 billion and the stock popped 7% in that one day. So Jamie Dimon did something really common called lowballing. They set their expectations very low, and when they beat expectations, everyone goes, wow, and it's something that our kids do. My daughter does it all the time. She comes back after her exam and says, oh, Daddy, I'm going to fail my exam. It's so tough. It's so difficult. And then she comes up with like an 80%. I go, wow, you're so smart. She gets a present, So people do that all the time. Always before earnings, analysts and CEOs will lower expectations, tell everyone that we're going to die, and then when they exceed expectations, they look like heroes. That's part of the game. And that's why you should never panic and sell because of some bad expectations that these people talk about. That's the number one mistake that people make. So far, roughly 20% of companies in the S&P 500 have announced their earnings, and more than 77% of those companies that announced reported way better results than feared. So you can see this article recently that better than feared earnings have analysts rethinking their projections. And this is really funny, because I remember that last year, many people were saying that analysts were too optimistic about earnings estimates, that they were too optimistic, earnings will come in worse than expected. But now the opposite has happened. Now, it looks like analysts were too conservative, and now earnings are coming in better than expected. So you can see over here, this is the current earnings quarter 1 2023. The one in black would be the number of companies that beat earnings, and it's way higher than the last 1, 2, 3, 4, 5 quarters. The best earnings beat in the last 5 quarters. Now, some people are saying that the stock market can't go up in the next few months. It has to go down because corporate earnings are going to contract. Wrong. Let me tell you why it's wrong. Because corporate earnings have already been contracting since quarter 2 of last year. Look at this chart. You can see that as of quarter 2, 2022 last year, these are earnings results. they have already been in an earnings recession, right? Earnings recession has already been underway. You can see earnings contracted here, contracted, and right now we're in quarter one earnings season. We are right now over here. So in other words, we are right now at the bottom of the earnings contraction. Now you may be wondering, hey, if earnings have been contracting for the last 4 quarters, how come the stock market has been going up? Because I keep telling you guys that the stock market is not the economy. The stock market doesn't care where we are now. The stock market cares where we are in the future. And the market tends to move 6 to 9 months ahead of the economy, ahead of corporate earnings. So what this means is that this quarter, earnings are negative, which they are. It's just that they are better than expected, and they are bottoming this quarter, right? So next quarter, we expect earnings to also be negative, but less negative. But in the second half of this year, we expect earnings to start growing again. So why do I believe that the stock market will keep going up from here? Because again, the market moves 6 to 9 months ahead of the economy, which is roughly about 2 to 4 quarters ahead. So the market doesn't care where we are now. The market cares where we are 2 to 4 quarters from now. So 2 to 4 quarters from now would be here, here, and here. So the market sees this in the future, and that's why the market is rallying in anticipation of the future. Now, we still have 80% of companies yet to report. So in the coming week, we have got our big tech companies like Microsoft and Apple to report. So again, we have to take a look. As long as the companies announce earnings that are better than expected, and they have got positive forward guidance, then we should see the market continue to rally and break above that resistance. But again, if they miss expectations or forward guidance is weak, then yeah, we could still have a pullback before eventually breaking higher in the second half of this year. Now, for entertainment purposes, let's take a look at economic data. Has economic data been strong? Well, yes and no. You've got some data that's been bullish and some data that's been bearish. So there's always two sides of the coin. So one bearish indicator is the index of leading economic indicators, or LEI. So you can see that in red, that's the leading economic indicators. It peaked in February of last year, and since then it's been coming down. In fact, it's down 1.2% as of March this year, and this historically has signaled a recession. It's a predictor of recession. So it looks like based on this, we're going to have a recession, which is nothing new. Already, I said in my last video that the Fed themselves already expect and project a recession this year. Let me say, but if it's a recession, will the market go down? Not necessarily, because again, the market has already priced in the earnings contraction from the recession. The market's priced it in. When everyone expects something to happen, it no longer hurts when it happens. Right? You find that bear markets happen, market crashes happen when recessions occur that no one expects. Let me give you an analogy. Now, if you walked on the street and someone came up to you suddenly and punched you in the stomach, you get a shock. You'd be like, oh, you'll be on the ground, right? Because you didn't expect it. Now, if you already expected that someone will punch you tomorrow, will you be shocked when it happens? No, you're already expecting to be punched. So what will you do? Number one, you may avoid going to that road, right? Or you may wear a bulletproof vest, or you wear something in your clothes so that when you're punched, you go, I expected that, right? So if every mother, son expects a recession and mentally prepared for recession, it's already priced into the markets. You get the point? Okay? So that doesn't mean that a recession will lead to another crash because the market already expects it. Yeah. Now, another economic indicator that came up was the Philly Fed survey, which was released on the 20th of April, and this was negative as well. You can see it showed that it contracted, the one in red, but at the same time, you've got the New York Fed Business Survey in April that was positive. It showed an uptick in business conditions. So like I said, there's always two sides to every coin. some indicators would say that recession coming, another set would say that no, economy is doing well. For example, if you take a look at consumer spending, remember 70% of US GDP is consumer spending, and as of first quarter 2023, it's still growing, right? Consumer spending is up 9% year on year to 1.1 trillion for the first quarter of this year. Now, if you take a look at the Atlanta Fed real GDP growth estimates, we are still right now real time projecting that first quarter GDP is up 2.5%. Again, so which one do you want to listen to is really up to you. Now, again, I keep saying that all these economic indicators are really useless in predicting the stock market. They are really useless in making investment decisions. You should always read this for entertainment purposes only. That's why there are no rich economists. The top economists have no freaking clue whether or not there's going to be a recession, and they change their mind all the time depending on what happens in the market, right? Like last year in December, 22nd of December, Mohammed Iran, is that how you pronounce his name? A top economist says that we can't avoid a recession. I mean, he said we can't avoid a recession. Now, 4 months later, on the 10th of April, now that same guy, I think it's the same guy, unless there's another guy called Mohammed Iran, and that's his evil twin, but he looks the same. Both have mustaches, both have interesting teeth. Both have blue ties. Looks like the same guy, right? Now, what does he say now? Now he says, I think we can avoid a recession. Huh? Right? This is a guy who said, we can't avoid a recession. Now we can avoid a recession. What the hell are you talking about? Right? So if you listen to him, over here you would have sold your stocks, and now it's gone up. You go, and now he says there's no recession. What are you doing? So ignore all these predictions. It's a complete waste of time, I keep saying. Now, so let me answer that first question that was asked at the start of this video, which is, if the Fed pauses, does that mean the market will go down, like what some people are assuming? Well, again, let's look at the facts, let's look at the data. Now, the interesting thing is that it's the same bears that said earlier on, don't fight the Fed. When the Fed raises interest rates, you got to sell your stocks, because when the Fed raises interest rates, the market will go down. Well, first, that's wrong. Now, if you take a look at all the rate hike cycles in the past, back in 1998, 1994, 97, 99, 04, 2015, and this rate hike cycle, you can see during the rate hike cycle, what happened? You can see the S&P went up 11%, went up 3%, went up 8%, 15%, 28%, and of course, this cycle, it went down 8%. So historically, when the Fed increases interest rates, more often than not, the market actually goes up. So when you say don't fight the Fed, that's complete bullshit, because when the Fed raises interest rates, the market actually goes up most of the time. Now, this time was different. When they raised rates, market went down. Why? Because it was not about raising rates. It's about raising rates too fast. It was the speed of the raising, not the raising itself. But what happens after they pause? So previously, you can see whenever the Fed pauses hiking rates, 6 months after the pause, the market's up 25% back in 88, up 20% back in 94, up 20% in 1997. Now, this one was down. The market went down 5.9% in 1999. This was because of the dot-com crash. So remember that it is not the pausing that causes the market to go down. It's something that happens. In this case, was the dot-com crash. So it's not a causation, if you will, all right? Now, 2004, market went up 12%. 2015, market went up 21%. And this time, we don't know yet. So once again, you can see more often than not, what happens after a pause? 6 months later, the market's up double digits. Now, what happens 12 months after the pause? Is it still up? Well, up 19%, 39%, up 41%. Now, this was still down because of the dot-com crash. Up 20%, up 33%. And this time, again, is to be determined. So once again, you can see that 90% of what you hear in the media, social media, is complete bullshit. When they say don't fight the Fed, that's total bullshit. When they say that the market's going to crash when the Fed pauses, that's total bullshit. Now, am I saying that the market must go up? I'm not saying that. I'm saying that no one can predict the market. That's what I'm saying. I'm saying that no matter what happens, stick to your investment plan, stick to your trading plan, and don't listen to all these nonsense predictions. It is totally not useful. Now, currently, the majority of market participants are still very, very bearish. So you can see in all these charts, first of all, the public, you can see this just came out on the 18th of April. Public pessimism on the economy hits a new high. So people are extremely pessimistic about the economy moving forward. If you take a look at fund managers out there, very, very pessimistic. Investor allocation to equities, which are stocks, relative to bonds, drops to the lowest levels since the global financial crisis. So as of April this year, you can see that it is very negative, which means the allocation to stocks is very negative, very low relative to bonds. So the last time it was low like that was in May 2020. That was right after the crash of COVID, and March 2009, there was a global financial crisis. How about the Bank of America fund management survey sentiment? So it turned even more bearish in April to the most pessimistic level so far in 2023. And again, like I said in the past, what happens when everyone is very pessimistic? When everyone is very bearish, the market tends to go the opposite direction, right? The bull markets are always born on extreme pessimism. Bull markets climb a wall of worry. So you can see over here where we are right now. Now again, back in May 2020, when we had that negative equity allocation, that was where we are in the markets right after that low. March 2009, again, right after that low over here. Again, I'm not saying that the market has to go up. What I'm saying is that it doesn't pay to be overly bearish in the market, because if you are very bearish like most people, you will never get invested, or you may sell in panic and you miss great opportunities. Instead, look at the individual companies. If they are great companies, they are undervalued, they're at a support level, you keep adding shares or holding your position. If you're a trader, you're looking to swing trade, take a look at the price action. If you see a breakout, you see a retracement, you can go long. If you see overextended, you see a downtrend, you go short. So make decisions based on your plan and ignore the predictions and the worries of the world. Hope you enjoyed it, and I'll see you guys in the next video. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.